no currency, no paper currency gives me more confidence than physical gold. Central banks throughout the world aren't just collecting gold because it's a pet rock. I think they're collecting gold because they don't trust paper money and they don't trust monetary and fiscal policy at the leading developed economies anymore. And so I think gold is rising despite the DXY is at 106. I know it was at 112 in last October. The dollar, to Brent's point, is still the best horse in the glue factory. It's still the best currency in the world. But despite a strong dollar, despite rising yields, despite FFR rates where they are in the last 18 months, gold is being incredibly resilient. And now it's actually approaching all-time highs.
Since 1933, the U.S. dollar has lost 92% of its domestic purchasing power. Even at its moderate 1994 inflation rate of 2.7%, the dollar lost another half of its purchasing power by 2022. According to IMF data, the dollar's global share of central bank foreign exchange reserves has significantly reduced to 59% in 2023 from 72% in 2000. J.P. Morgan's Global Research Report states, the risk of de-dollarization, which is a periodically recurrent theme throughout post-war history, has returned into focus due to geopolitical and geostrategic shifts. Matthew Piepenburg, partner of Matterhorn Asset Management, emphasizes that despite fluctuations in the currency's relative strength, its intrinsic purchasing power has been weakening over the years. While there may be occasional spikes in current purchasing power, the long-term trend, when measured against gold, shows a consistent decline. Even central banks worldwide are accumulating gold, not because it's a mere pet rock, but because they have lost trust in paper money and the monetary and fiscal policies of leading developed economies. Gold purchases by global central banks reached a record for the first 9 months of this year, according to a report from the World Gold Council. As the reliance on U.S. dollars diminishes, central banks will begin dumping their dollar reserves. In the long term, Matthew doesn't foresee a default risk for the U.S., but rather a continued reliance on printing more money to support its bonds and maintain control over yields. This in turn could lead to inflation and further currency devaluation. The U.S. government struggles to balance its budget, and the growing disparity between spending and tax receipts indicates that the currency is likely to be debased further. He predicts that the current state of the U.S. dollar and its monetary policy is unsustainable, and that it is essential to prepare for potential economic challenges ahead, even though the specific triggers are unpredictable. We will now present clips from Matthew Piepenburg's interview with David Lin. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Currency is dying. It's burning in front of us. Despite the DXY or its relative strength, its inherent purchasing power gets weaker and weaker by the year. There are spikes where current purchasing power can shift higher or lower. The dollar can go higher or lower. To Brent Johnson's point, I agree. But the long-term trend is, when measured against gold, it just gets weaker. Not every day, not in a straight line, but historically, I would much rather own I would much rather preserve my wealth in a monetary metal than in a paper asset, even if it's the world reserve currency, because this world reserve currency is in a historical debt pattern that it can't get out of without debasing it even further. I think people have cognitive dissonance. They still believe it's the bond market of 40 years ago or 10 years ago, or it's the US dollar when Kissinger and Nixon before they welched, but it's not. We're just not that same country. And I'm an American, I'm a patriot. I love the iconic America, but I see a debt-soaked America, a debased currency, an unloved IOU, and a monetary and fiscal policy that's completely at odds with themselves. And that's not to be doom and gloom. It's to be as realistic as I can. I think gold is rising despite the DXY is at 106. I know it was at 112 in last October. The dollar, to Brent's point, is still the best horse in the glue factory. It's still the best currency in the world. But despite a strong dollar, despite rising yields, despite FFR rates where they are in the last 18 months, gold is being incredibly resilient. And now it's actually approaching all-time highs. Not there yet. And I'm not here to tell you when, but it's fascinating. I think it's a combination of fear. It's a combination of chaos. It's a combination of lack of distrust in the American narrative in general, politically, socially, etc. It's also a lack of trust in the American dollar longer term. I mean, it was James Turk is talking about default risk in the U.S. I don't see default risk. I just see a continually continuing to get to the point where they're going to have to print more money to support those bonds and keep those yields under control. That will be inflationary. That will debase the currency. And I think people are realizing what's the U.S. going to do? Where's it going to get its growth from? What kind of GDP? We need 30, 40% GDP annually to get us back. We need to cut spending by 70%. It's never going to happen. So those who just look at the simple, stupid metrics of debt and spending don't see any way out for the dollar but something Japanese, where they're going to have to debase even the world reserve currency to support an over its ski debt problem, an unprecedented debt problem. And then we have a DC that can't even agree party to party or among parties and is going to do more spending next year. We simply are spending more than we make. Tax receipts and GDP don't pay for it. Currency is going to be debased. Again, we've had backdoor pivots to the BTFP, to the Treasury Department. We're going to have outright pivots or outright yield curve control eventually. And I'm not talking 30 years from now. I'm talking in the next few years or even the next few minutes. I don't know. No one really does. But you don't need to be a weatherman to look out at the horizon and say, those are gray clouds. I got to get an umbrella and rubber boots on today. I don't know if it's going to rain at noon or 12:30 or 3:30. I just need to prepare for the rain. And I don't know what will be the headline. Will it be Martians? Will it be COVID? Will it be another pandemic? Will it be some other bad guy in the world? But the real problem with the US dollar isn't the BRICS. It isn't Putin. It isn't COVID. It's our policymakers. Generation since 71 that welched on the gold-backed currency, got rid of the chaperone. We've been spending more to get reelected or get Nobel Prizes by printing money out of thin air. It's not sustainable policy. A 10-year-old could see that eventually if you just look at the math. I'm not trying to be flippant. It just doesn't work. And I'm not trying to be dramatic either, because I don't think it's the end of the dollar. It's not the end of America. It's not the end of civilization. It's just not going to be the same 10 years as it was the last 10 years. And it's not the same dollar, and it's not the same IOU. And the evidence is overwhelming. It's not even predictable. It's happening right now. The evidence of a soft landing is not here. The evidence of a hard landing is everywhere. The fact that gold is rising in this environment proves that people don't trust these currencies and IOUs anymore.
Matthew emphasizes that the world is unlikely to return to a gold-backed currency system or embrace the idea of gold bars as the basis for a new monetary standard. The BRICS economic alliance has undoubtedly influenced the global acquisition of gold as many countries seek to ditch their US dollar, USD reserves. Indeed, the economic bloc has set out on a de-dollarization plan to promote local currencies further. Subsequently, central banks have been purchasing gold at record rates. Matthew even predicts that what we're witnessing is a growing trend over the past 2 years in which central banks are reducing their holdings of U.S. treasuries and increasing their holdings of physical gold. According to a new report from Markets Insider, various central banks seek to reduce an over-concentration of dollar reserves. Therefore, these countries have opted to purchase record amounts of the metal. The move aligns with overall BRICS activity throughout the year and the poor performance of the greenback. In this scenario, the Fed may boost the U.S. bond market by increasing asset purchases, potentially affecting the U.S. dollar. According to Matthew, this move wouldn't crash the dollar, but would continue the process of currency debasement. He expects the Fed to eventually pivot, creating synthetic liquidity and debasing the currency to buy government debt. Let's get back to the interview.
In terms of world reserve currency, the US dollar is still supreme. It's just its hegemony has changed dramatically. And no, and yes, I'm a gold executive out of Switzerland. It's not going to be the gold bar either. It's not going to be a gold-backed currency. But what you're going to just see is what we're seeing in the last 2 years, central banks dumping US treasuries and stacking physical gold at record high levels. And even investors, and we have investors that are high net worth and fairly sophisticated, they know there's not going to be a gold-backed currency either, like the BRICS, but they can become gold-backed themselves. We can each become our own central banker from our own home or our own vault or our own storage facility, however we choose. And that's what a lot of sophisticated investors do. And I'm not going to name names. I knew a lot of guys from Wall Street and the hedge fund world who are portfolio managers who trade in arbitrage, credits, equities, long, short, multi-strat funds, and they don't trade gold in their books that they take their 2 and 20 on, but when they have their own personal money, they invest in gold vaults somewhere outside of the US. And the smart money is basically trying to solve their own currency problem on their own. And retail investors are doing the same thing, where they put it in a shoebox or they put it in a private vault somewhere in the Swiss Alps. More and more people are catching on that the inherent purchasing power of their Canadian, Australian, American dollar, or of their euro or kroner or French or Swiss franc just isn't what it used to be, and is going to continue to get weaker as national decision makers debase their currency to pay off debt. I don't think it'll crash the dollar, it'll just continue to debase the dollar. I think, again, I don't want to say the implosion, crash, end of the world, but What we're doing right now is we're QTing, we're reducing our balance sheet and raising rates into a debt crisis. You had Richard Werner on the other day. That's not where QE works best, and it's really best in a deflationary crisis. We won't get into that stovepipe, but the fact that we're QTing or reducing the balance sheet and raising rates right now doesn't mean we're going to be doing that in the future. It's inevitable, but we will eventually have to create synthetic liquidity. We'll have to debase the currency to purchase our own IOUs. Right now, we're not doing that. I think Powell is only raising rates and reducing the balance sheet because we are already in a recession. We can go into that. When we're officially by the NBER in a recession, he's going to need to reduce rates and fatten the balance sheet, like he tried to do in 2018 and had to pivot by 2019 and unlimited QE in 2020. Powell's just reloading his two revolvers because he only has two tools, rates and balance sheet. And he needs higher rates now so he can reduce them when we have no doubt that we're in a recession. And he needs a thinner balance sheet so that he can fatten it when we need to print more money. I think he's just buying ammunition and buying time. We will pivot. And again, Ronnie Sturfula, myself, Rick Rule, certainly Groman, we all agree on this. I think even Brent Johnson agrees at some point. It's not 50 years from now. It's not even 20 years from now. It's when things really break. To me, they're already broken. It's not even a soft landing. We can get into the data on that. We probably need more than a half hour on that. We're massively in a hard landing now, from Main Street to Wall Street to banks, in my opinion. But the Fed will at some point get to the point where they're going to have to either reduce to QE or refill the TGA, or they're going to go to yield curve controls unless, again, we cut spending by 70%, which I don't see possible. I don't see any way out other than more synthetic mouse click money.
Gold is considered a safer store of value than the US dollar due to its historical stability and resilience during economic uncertainty. Unlike the dollar, gold's limited supply and tangibility make it a favored hedge against currency devaluation. What are your thoughts on investing in gold as a hedge against the US dollar? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.